How much do I need to start investing in gold? A better question is, how much of my specific wealth or investment capital should I allocate at any one time to gold? In part 2 of this 2-part video series, I will discuss some gold investing strategies from popular and successful investors. Learning from wealthy capital investors with decades of experience provides greater proof of concept and success. See the link in the video description to read the full article. Also, I will share 2 sound gold investing options, each with their own unique advantages. Be sure to watch the entire video so you don't miss them. If you are unsure right now how your net worth or savings stack up against inflation and the average age of retirement, see the link in the video description to access the free Inflation Retirement Calculator. For inflation hedging and portfolio diversification, the standard rule is an allocation of 10%. For a more expert perspective, let's find out how much experienced, forward-looking investors allocate to gold. In no particular order, next on our list is Jim Rickards. Jim Rickards is an American lawyer, economist, investment banker, speaker, media commentator, and New York Times bestselling author on matters of finance, geopolitics, and precious metals. Rickards maintains that investors hold 10% of their portfolio in gold at any one time as a hedge against currency devaluation and market volatility. He also disclosed that he personally holds up to 20% of his portfolio in gold and gold-related investments. He states that the increasing instability of the dollar's reserve currency status in global trade and the rising BRICS Plus nations' desire to de-dollarize in favor of hard assets like gold will effectively drive up the price of gold. Gold, due to its scarcity, value, and historic ability to establish trust, will likely continue to be used as a means of settlement among these Eastern nations, further minimizing their need to rely on the dollar as a means of trade and reserve. Given 2022 and 2023's record mass purchasing of gold by central banks, there is clearly a race for this precious metal and therefore a resulting increase in the price of gold. Tavi Costa, global macro analyst at Crescent Capital and guest speaker to the International Monetary Fund, expects a rapid reemergence of inflation similar to the stagflation environment of the 1970s and 1980s. He is a proponent of owning a variety of commodities, with gold being the larger percentage. With the trend of central banks moving from U.S. treasuries to gold as a reserve, this will result in the eventual resurgence of inflation, unsustainable corporate and sovereign debt, and overvalued equities. He sees the standard portfolio shifting to 20 to 30% in gold as a growth asset, not just a defensive asset. This policy reversal from U.S. treasuries to gold purchases signals a return to historical averages where central banks hold up to 40% ownership of gold relative to international reserves, similar to the 1970s. This increase to 40% gold reserves would require the addition of approximately $3 trillion in central bank gold purchases, which would result in a 25% increase in the value of gold above ground. This alone would push gold prices to record levels. Historically, when this trend among central banks starts moving to hard assets such as gold, smaller institutions, 60-40 portfolios, as well as endowment funds start to trend in that direction as well. Again, similar to what was seen in the 1970s. The allocated percentage would move beyond the standard 10% hedged position. In Tavi's view, gold is a neutral asset with no counterparty risk that also carries centuries of credible history as a safe haven asset and monetary alternative. He sees the shift inevitable unless the mass amounts of private and public debt can be resolved in the short term. You don't have to be a cynical person to see that is far less of a possibility. Leveraging the expertise of macroeconomists like Tavi Costa is important, especially when embarking into a new investment asset class, such as gold. When starting on the path of gold investing, working with a credible and trustworthy precious metals vendor is key. Finding an established gold investment company that understands the many fluctuations of the gold markets and the numerous variables affecting its price will save much time and hassle. Working with a reputable company can guide you as a beginner when investing in gold based off your own present individual finances. Armed with experience and institutional knowledge, these companies can assist you with logical price entry points, positioning, and dollar cost averaging so you can maximize your gold investment. Gold IRAs provide additional benefits compared to merely buying gold from a local dealer. These companies can provide access to competitive prices, transparency, price match guarantees, a sound buyback policy, reliable customer service, and robust security and protection of your precious metals. See the links in the video description to find the right gold IRA company for you. Next on our list is Naguib Sawiris, one of Egypt's wealthiest men, former chairman of Orascom TMT Investments. Sawiris holds about a quarter of his wealth in gold and recommends holding 20 to 30% of your portfolio in gold. The billionaire even launched a $1.4 billion gold mining fund and sees gold as a buffer against market risks. Robert Kiyosaki, millionaire, real estate investor, and founder of Global LLC and Rich Dad Company, has publicly stated that he allocates around 10% of his portfolio to gold as a hedge against currency debasement and political risk. He believes that gold and silver are wise hedges against inflation and unpredictability. Kevin O'Leary, the famous investor from the ABC show Shark Tank and chairman of O'Leary Capital, has publicly stated on YouTube that he keeps 5% of his portfolio allocated to gold at all times with annual rebalancing. Quoted at the beginning of 2023, gold over a very long period of time has proven to make very big moves in very short periods of time. O'Leary typically does not own gold mining stocks, prefers the physical gold itself and well-managed ETFs. A common objection to holding gold is the opportunity cost of gaining yields elsewhere, such as bonds or high-quality equities. Monetary Metals is a gold investment company that unlocks the productivity of gold by offering a yield on gold paid in gold. Monetary Metals delivers interest on gold through the company's gold fixed income investment products, which aim to provide a fixed return with low risk of loss. This provides investors exposure to gold's unique attributes, plus a real yield that grows total gold ounces held by the investor. To learn more about Monetary Metals investment products and get started today, see the link in the video description. Among notable mentions, Sam Zell, the late real estate titan with an estimated net worth of $5.5 billion. Zell believed in buying gold as a hedge against inflation and other risks. He bought gold for the first time in January 2019. Prior to this, Zell had stated that he never saw the appeal of gold as it doesn't generate income and requires storage. But the current debasement of currency due to rising inflation has made him reconsider. He expressed concerns about global governments resorting to printing money to mitigate the economic impact of the COVID-19 pandemic and compared the current economic situation to that of the 1970s. As the old adage goes, success leaves clues. Following in the tracks of successful investors that have decades of experience and have survived multiple business cycles and downturns can shed light on how to invest in gold as a beginner. Please like and share if you enjoyed this video content. Also, subscribe to our channel so you don't miss the next video. If you are a serious investor with at least $100K in retirement savings and want to take advantage of the best gold prices, see the link in the video description to attend a free gold educational webinar hosted by Augusta Precious Metals. Thank you for watching.